You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. All right, last week we looked at a back spread in coin and in general, my rationale behind Coinbase, one of the biggest IPOs to hit the market, and it came via direct IPO. They did not do it by the standard means of using a huge investment banker, i.e. Goldman Sachs overall. And that stock has had its trials and tribulations ever since it became a public company. Stock ran up to $430 approximately, only for about a second or two. And right now, today, we are taping Options Playbook Radio on May 12th. The markets are closed. Coinbase was down $19.39. The last trade was at $283.61. And as always, or I shouldn't say as always, what I've mentioned a few times on a lot of the educational events, that the implied volatilities just seem to hang in that 60-70% range. Now, we are going to have earnings, so that has changed things up a little bit. But the stock has continually been more volatile than what the options marketplace is implying. So last week, we looked at a back spread with calls, being a little bit bullish on the underlying, but we did a little differently because we're going into earnings. We figured we would use an at-the-money back spread. In other words, we were going to sell the at-the-money call and go a little bit out of the money and buy two out-of-the-money puts and bring in enough of a credit that it would cover those two out-of-the-money puts, and we were able to achieve that goal. So we last week looked at with Coinbase had a fairly big down day on that day. It was down $7.66. The market was at 273. So this was last week, May 5th, and we sold the 275 call, kind of the most at-the-money call option available, and used the proceeds to buy two of the 297.50 calls. We were able to get that done for a net credit to the account of $1.20. Since then, the underlying stock has gone down and gone back up and gone down and gone back up. It got all the way up above 300. And as I mentioned today, we see it down $19 at 283.61. Coinbase is expected to announce earnings tomorrow after the close, their first earnings announcement. If we look at that May expiration, we now see that that is trading at about a 93% implied volatility. And if we go all the way out in time and we look at like the June expiration, we're at a 76% volatility. Now, the market overall, relative to other stocks in the marketplace, considering this is a new IPO that's about to announce earnings, that still seems like a fairly safe implied volatility relative to what the underlying stock has done. So the expected move on Coinbase after earnings right now, by looking at the 285 strike long straddle, is trading right around 23 points. Well, it just made that move today as an example, just to try to highlight my point. So on that trade, you could have got, when the stock ran up above 300, I would have definitely thought about just getting out, because you would have had a situation where the implied volatility of the option contracts has increased from last week, and without a doubt it has. It's up probably about 10 percentage point, if my memory serves me correctly, from last week and the numbers we were looking at. And you also had the underlying stock go up above your call strike. So you should have been up pretty handedly. But right now, you put the trade on for $1.20 net credit to the account if you filled somewhere by the midpoint. Now, once again, paper trade, should say paper trade. On paper, you should have filled somewhere right around 120. And now you could actually sell this position and get out of the position. And by sell, I mean you would sell to close your long contract and buy to close your short contract, and still bring in a net credit of 95 cents. Hence, the total net credit to your account would be $2.15 overall from putting this trade on. Your maximum risk on this trade, whenever you're doing these back spreads, are the width between the spreads. But in order to lose that maximum, the stock has to stop right at your short strike, right at expiration. So the maximum, the width between the strikes was 40 points, which was $4,000. So overall, I would have rather just closed the trade out, because we did have the move and not take the risk of this trade going into earnings. But I don't mind if you hold it either. Like I said, it's hard to lose the maximum on the trade, and obviously it depends on how many spreads that you are doing. So the market has helped you out a little bit going into earnings, but at this point in time, you can decide exactly what you wanted to do with that trade. Okay. I think we'll be talking about Coinbase once again. Very, very interested in this earnings. One of the more profitable IPO companies that have came out. They should. Nobody obviously really knows, but they're anticipating that they might do more revenue in the first earnings report this first quarter than they did the entire year of 2020. That's some people are speculating that could be true. Okay. Once again, that's not meant to be a recommendation. As always on Options Playbook Radio, we're just trying to learn here. So let's keep the theme going. I think tomorrow we also have Airbnb, another very speculative stock that has gotten beaten up quite a bit. And we've looked at a couple of different trades based around earnings recently. So let's go back to an old favorite that we haven't talked about in a while. We're going to look at a skip strike butterfly in Airbnb. One of the things that I've emphasized many times around earnings, when companies announce on the Thursday, and this Airbnb is supposed to announce tomorrow, the 15th, tomorrow, the 13th after the close. So that means that the option contracts have 1 day to live. Airbnb is $140 stock. It's the pricing of Airbnb. Let's not even talk about the company. Let's just talk about the pricing. Just makes it an interesting butterfly because it's a $140 stock. It's got pumped up volatility. Airbnb, which has been around, it's one of the, right now, ideally, on paper, it's one of the biggest hotel chains in the world. Actually, I think it's the biggest hotel chain in the entire world, and they don't own a hotel, interesting enough. But just for example, they're going to be announcing earnings the same time that Coinbase is, and their at the money implied volatility for the same expiration as Coinbase is 165. So even more volatile than Coinbase, even though that's an IPO. Interesting enough. Okay, so with that said, what we're going to look at doing is we're going to use the shortest expiration here, because when we're doing a butterfly and we're correct on our forecast, we need time decay. We want our at the money option contracts, if we're correct that they would be at the money, we want those contracts to decay and go away so we can make the maximum on our trade. So Airbnb being a $140 stock, them announcing earnings on a Thursday, meaning that we can trade option contracts that only have 1 day to live. To me, that is a good setup for doing a strategy like a butterfly, as opposed to a lot of different type of strategies. Now, you got to anticipate a little bit of a tamer marketplace if you're doing a butterfly. We're going to try to pick a range, and as opposed to where I wouldn't want to do this in Coinbase, only because I do think the market could be more volatile than what the marketplace is intending. In Airbnb, if you're doing a butterfly, your risk is that it blows away earnings on the upside if you're doing it using calls, or on the downside, it gets killed by earnings or after earnings, and that would be your biggest risk in this scenario. Okay, so Airbnb closed today at $140.25, down $2.48. Today, right now, the markets are closed. It is Wednesday, May 5th. We look at the most at the money straddle to get a feel for the strike prices that we would like to pick. So with the market right at 140.25, we are looking at the 140 strike. The midpoint on the call and on the put puts it just below $14, but it's not an exact science, so we'll call it $14 to make the math simple. So if we add 14 to 140, that would get us at 154. So we want to go beyond 154. We're going to look at doing the 155, which is a little bit tight. You could look at the 160s. There's enough juice that you could go up to the 160s, but I don't do the 155s here. I want to bring in more of a credit. I'm going to lean a little bit more bearish with this Airbnb trade. It's going to only last for 1 day after we put it on. Now, ideally, we're putting it on right now because we're taping Options Playbook Radio after the market close on a Wednesday. But I would probably place this trade a little bit closer to the close tomorrow. But that's all right. This is when we tape it. These are the numbers we're going to use. We'll be selling the 155 strike option contract. I'm sorry, buying the 155 strike option contract, selling the 160 strike option contract, skipping the 165, and then buying the 170 overall. So that's what makes it the skip strike. By skipping the 165, that would be the normal butterfly. We're going to skip that strike, and then we will embed basically a credit spread into this account so that we can get this done for a net credit to the account. So using the May 14th expiration, which will expire this Friday, we're going to be buying the 155 strike calls, selling 2 of the 160 strike calls, and buying 1 of the 170 strike calls. Midpoint right now is right around a 10-cent net credit to the account. So if the market does go down in this instance, the maximum we can make, if it went down or stayed right where it was at, would be 10 cents. If all the option contracts expired worthless, we got this done for a net credit of 10 cents to the account, then that would be our maximum upside if the market went down. Now, if we do get the expected move, or ideally a little bit more on the open after the earnings report, Our ideal situation would be that it stopped right at 160, right at the expiration date, but anywhere between 155 and 165 should be a bonus. We should still be able to close this butterfly for a credit to the account overall. And so we'd put this trade on for a net credit and be able to close it out for a net credit. So this isn't a trade that you're going to hang around in. We have risk. We have risk from 165 to 170, which is the strike that we skipped in the skip strike butterfly to 170. That adds $5 worth of risk to the position. And we're at risk because we have 1 day. So if the market does open up and goes straight to 175, for example, blows through all of our strikes, we want to close it as soon as possible. We want to try to salvage the position and just get out of the trade. So to me, this is a trade that you're going to put on. You're going to look to get out between Eastern time. Market opens at 9:30, probably be out of it somewhere between 10 o'clock and noon, unless the market stays right where it's at or goes down, right? Because then we have no concerns. If the market is going towards our butterfly strikes, well, then we're going to have to watch it closely throughout the day. And just a very simple, straightforward, speculative trade based off of Airbnb being a $140 stock and announcing earnings on a Thursday, which gives 1 day for the option contracts to live. All right, that's going to be it for this episode of Options Playbook Radio. We'll come back next week and we'll see how Coinbase did and also Airbnb around earnings. And if you have a topic you'd like us to discuss on the show or a question you'd like us to answer on the program, send them directly to me at theoptionsguy@invest.ally.com. Please follow me on Twitter. My handle is @BrianOverby. Thanks for listening, and we'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.